Unfortunately, it's highly likely that the United States will never be able to pay down our national debt, which currently is a little over $35 trillion. To put that in perspective, it's over $100,000 for every man, woman, and child in the United States. So for a household of three, 2 adults, 1 child, that's $300,000 in debt, and the median household makes $75,000 a year. So 100% of their pay for 4 years to pay down the national debt. So let's talk about how we got here and what we can do to get out of the situation and what's likely going to happen. Okay, the first chart I want to open because often people will say, well, it's this political party's problem or this political party got us into this situation. And this is our situation. This is not a political channel. But this chart here shows over time, the blue is the Democrats, the red is the Republicans. So everybody has a little bit of blame in here. So that shows the growth. And this was a year ago in 2023 at 30, when it was only $31 trillion. Okay, and this shows what the projections are going forward. So you can see right now, it's not due to go down, it's due to go up, unfortunately. You can see that there was a peak in World War II, and we did a nice job of paying down that debt for a while, but the world's very different now than it was right after World War II. And part of that, frankly, is just the corporate taxes. Corporate taxes were much higher. This is not a political statement. I'm not saying whether corporations should pay more or not, but it's just a reality. Corporations were paying a much higher tax rate earlier. Okay, and this shows how did we get in this situation? Why are we in this situation? It's no different than our households, right? If we spend more than we make, then we're going to go into debt. And for most of us, that means credit card debt. And that usually doesn't end well for people. You can do it for a while, but it usually doesn't end well for people. Now, I'm not saying it's not going to end well for the U.S. government. Stick to the end to hear this, but you can see what the U.S.'s revenues are and what our spending is. And that gap, the difference between what we're getting in revenue and what we're spending is continuing to increase. So that's our annual deficit, is the difference between that. And then the national debt is just the accumulation of it. So think of the deficit as how much more money you're spending every month, and then think of the debt as what you owe on your credit card, right? Many of us in our personal situation would use our credit cards to bridge that gap. Now, fortunately, the U.S. government's not paying 25% on our debt, but the interest rates are going up in what we're paying. It wasn't that long ago that 30-year treasuries were paying incredibly low interest rates, but that number has increased dramatically, as has the 10-year treasury. So let's look at where do we get our revenue from? And so you can see these breakouts here. The largest source is individual income taxes. People are generally surprised to see that corporate taxes are generally much smaller than what they think it's going to be. So individual income taxes is not quite half. And then Social Security taxes, the payroll taxes, is another big piece of the revenue. And so where does our money go? What are the expenses on? Right now you can see pensions and Social Security is about 17%. But look at this category here, healthcare, 23%, and that number is going to keep going up. Then we have education at almost 20%. Our defense is about 12%. Welfare is about 7% of the revenue that's coming in to the U.S. government, or this is the percentage of our spending, I should say. And then the other category is about 16%. And right now, fortunately, interest is only 6%, but the projections are that that's going to go up and go up dramatically. So I talked about after World War II, corporate taxes were higher. Again, this is not political, but it's part of the reason why we were able to pay down that debt after World War II. And that is, you can see here what the individual income taxes are as a percent of total federal revenue. So it's about 50% comes from our income taxes. And right now it's less than 10% is coming from corporations. And we saw the corporate income tax in that pie chart at about 10% as well. Okay, so one of the things is healthcare programs, which would be our Medicare, which would be Medicaid, and other programs that the government runs to help people afford healthcare. And you can see that major healthcare programs are projected to go up and go up pretty dramatically. Now, there's a lot of talk about Social Security, and rightfully so. The chairperson of the Social Security Trust Fund, Janet Yellen, who's also the U.S. Treasury Secretary, reports once a year on the health of the Social Security Trust Fund, which is the surplus that the government had collected for many years while there was more Social Security tax coming in than benefits being paid. And Janet Yellen reports that that surplus is due to run out sometime in the next 10 to 12 years. It changes every year. Now, what happens when that Social Security Trust Fund completely goes away? Does that mean that Social Security is going away? It does. Fortunately, it does not. What Janet Yellen says is the current tax base is sufficient to fund 70 to 80% of the benefits that are going to be paid out. So that's a big deal, because if we don't do anything, currently, if we don't do anything, it probably means there's going to be cuts to benefits. I don't have a crystal ball. That's if we don't do anything. I think something will be done. It doesn't mean Social Security goes away, but it could mean that current recipients get a haircut. They no longer receive their full benefits. So 10 years is not that long in a political history, but you can see in this chart here that the Social Security increases are not due to be that dramatic. In fact, healthcare costs, the healthcare programs makes the Social Security problem, and it's less of an issue for us as a government, but it's still a huge issue. I do think that the politicians will get together and they will figure something out. I've read recently that about half of all Social Security, new Social Security eligible people are choosing to take their benefits earlier than what they otherwise would because they're worried about the trust fund running out of money. Okay, so who owns all this debt, right? So if we have $35 trillion of debt that we owe, it's one thing if you owe your parents money, and it's another thing if you owe the bank money, right? The bank's going to force you into bankruptcy. Your parents probably aren't going to force you into bankruptcy. And here's kind of the good news is over a third of all of the U.S. debt is owned by the Federal Reserve. And where do they get the money to buy these treasuries? It's how they literally just print money. It's how the Federal Reserve puts money into the system. It's one of the ways that the Federal Reserve puts money into the system. They just create money out of thin air because they're allowed to print it and buy up U.S. treasuries. And when they do that, it provides capital. So let's say there's a broker that's selling U.S. treasuries. The U.S. government can use their money, can print money to actually buy up those treasuries. So the good news is about a third of that is owed to the Federal Reserve, the federal government. It's owed to ourselves. But almost 25% is owned to foreign countries. So that's who owns our debt. So think of the Federal Reserve as owing money to mom and dad, and the other players is owing money to the bank. So those other players aren't going to forgive this debt, right? We've got to pay it back. Now with the U.S. Treasury, they can just print more money and buy more treasuries and use that to continue buying treasuries. But eventually, foreign countries are going to quit buying our government debt, or they're going to buy less of it, and we've already seen it. But I think the big gotcha is with interest rates. Because interest rates were so low recently, the amount that we're paying on interest is lower than it's likely going to be a couple years from now, just current interest rates. As low interest debt matures and the government issues new debt to fund that deficit, they're likely, who knows, I don't know, and interest rates are one of the hardest things to forecast, but we're likely going to have to pay a higher interest rate on that. So all of this to lay the groundwork for what do I think is going to happen. Well, a couple things. One is most governments inflate away part of the pain of repaying debt. Think about over the last 4 or 5 years. Inflation's been real. And over the last 4 or 5 years, that number's probably north of 20%. So repaying the debt that we borrowed 5 years ago feels 20% easier than it did 5 years ago. But obviously, there's a limit to it. Now, as a country that is the reserve currency for the world, there's many smart people that would argue the pressures on the U.S. is much different and much lower than it would be on any other country that doesn't get to print the world's reserve currency. And for instance, let's say we had euros and we owed all of this debt in euros. Well, as the U.S. were to print more money and convert it into euros, that has an impact, and eventually your currency gets inflated and that exchange rate changes. We're fortunate that we're issuing debt in our currency. The currency that the U.S. is paying back that debt in is one and the same. For many countries, they're borrowing money in U.S. dollars. They have to pay back U.S. dollars, but they have their own currency. So as they inflate their currency, it makes it harder because then they need more of their dollars to get U.S. dollars to pay back that debt. And that is the inflation spiral that every country faces if they use too much inflation. These economists, these PhDs, these smart people would say, because we're the world currency and because we're paying back in US dollars, it's less of an issue. I agree it's less of an issue. What none of us know is it really not an issue? Because if we don't get our spending under control, then we have no choice. We have to just leave that debt there and kind of inflate away, which I think it's going to be a combination. We're already seeing us inflating away the numbers. And then the other thing we have to do, which we have not already seen since World War II, we need to start decreasing that gap, that deficit that's occurring. We need to first decrease that deficit. But that's hard because these are all programs that people rely on. You know, do we want Social Security to get cut? Most of us do not want that. Do we want Medicare benefits to get cut? Most of us don't want that. So, and those are some of the biggest sources of our spending. So part of it is fiscal discipline, and the other part of it is inflating away. So do I think there'll be a time in my lifetime when the U.S. national debt gets paid off? No, I don't. Do I think there'll be a time in my children's lifetime where the U.S. debt gets paid off? No, I don't. So I don't think the U.S. ever pays off our national debt. And it becomes a combination of making some difficult decisions to tighten that gap between the revenue that's coming in and how much we're spending and inflating away that. And the fact that the U.S. currency is the world exchange currency benefits us and makes our challenge a little bit easier. And if you like this video, where really what I'm talking about is making good decisions. What do we do to address this issue? And that's why I made this video up here that also talks about making good decision, which is retiring at 65, why that might be a mistake, and why you might want to think about retiring sooner. Thanks for watching this video, and I'll see you in the next one. Bye-bye.